feel like some of the best sponsors we've seen, they've been prudent to be, quick to make those pivots as it's necessary, as opposed to trying to continue to push through something that the market really isn't accepting right now.
Welcome everyone to The Landscape. This is George Smith Partners podcast. We're very excited to have you all here today. I'm here joined by my co-host, Mr. David Pascal.
Hello, everyone. Good to see you.
If you're not subscribed, please go to our website, gspartners.com, and subscribe to FinFacts there on the website. You can find the podcast just about anywhere where you can find podcasts, Apple Podcasts, Spotify, etc. Today, we have a very special guest, Mr. JP Ackerman. I'll let JP introduce himself and his platform, and I'll just get out of the way here. So JP, tell us a little bit about yourself and your platform, and then we have a whole bunch of great questions for you.
Well, thanks for having me today on the podcast, guys. For anybody who had the opportunity to work with or meet, my name's JP Ackerman. I'm the CRO and co-founder of Techo Real Estate Capital. And Techo, which is roof in Spanish, is a platform we founded almost 4 years ago now to really focus on bridge lending with an emphasis on ground-up construction for attainably priced housing throughout the United States. As a platform, we've really tried to take an emphasis on funding communities and sponsors who are making a difference in the supply of attainable price housing that serves middle income for rent or for sale households. And we've continued to expand that into different price segments and different purpose segments. But at our core, we really try to fund communities that make an impact. And so while we don't focus on capital A affordable housing, we really like those that do make a difference in the residents' social outcomes over longer periods of time. So we've had the opportunity to do a lot of non-standard projects like modular, adaptive reuse, while an enormous focus again on built to rent, built to sell, some traditional multifamily along the way, and increasingly acquisition and development type of lending for the benefit of single family residential development. I come from a long background in development and around real estate. And so sort of core to our platform is bringing some of that expertise and what it's like living as a developer. We've raised GP funds that come largely from development platforms. And so we have a lot of that DNA in how we act, how we think. And as we're typically only lending off balance sheet, we really try to look through to the real risks and deals and structure accordingly, as opposed to having to lean into securitization rules or the regulatory environment that banks often have to operate in. So we are really enthusiastic about the market that we see today and look forward to a lot of activity in the months and quarters to come, as I think we're building into a much more supply balanced environment. And while it's rough waters today, that optimistic outlook, I think, gives us a lot of confidence for what it's going to be in 26, 27, and 28.
That's awesome.
Good.
Before we get into too many detailed questions here, tell us a little bit about the sizes of loans you're trying to make. What's your target for this year? What are you trying to put out in capital next year? Give us a little sense of where we're going and what we're doing.
Sure, thanks. At our core, we're trying to put out probably $1 billion in commitments this year and 2 to 3 next. We really are leaning into the environment, as I said, with some of the segments being a bit non-standard to what other lenders are leaning into, like for sale. We're really enthusiastic about that. When we look at the deal sizes themselves, we're typically looking at deal sizes 150 million or below, with check sizes that are sub 100 million. Though we'll stretch farther. We're working at a couple $500 million projects right now, and while they're off ramps, we have programs that can take it the entire distance. And so we are optimistic to scale into some of those larger loans, and at the same time, we're very active on smaller ones as well, and just trying to slot them into the different pools of capital. So I think the smallest one we're working on right now is around 10 million, but we've done those that are 5, and it just, as long as we can be efficient and think about the longevity of a relationship and repeat borrowing, we like those relationships of the 3rd, 4th, and 5th loans much more than the first.
Yeah, and I know that it's funny you bring up those deal sizes. We have a couple of deals that we're working on with you. I think one's for 10 million, and one's for 150 so of debt. So that's kind of funny. We're covering the gamut here with you.
That's right. That's right.
David, you want to kick us off with some thoughts here?
Yeah, I'm interested in the kind of non-conforming types of residential real estate that you are providing liquidity for. As we know, the agencies are a little gun shy on things like co-living, modular, et cetera, but yet these are, in certain environments, critical housing providers. Give me just some of your thoughts on the risk metrics and on some of these other types of real estate.
David, it's a good question. I think they're using those two examples. They're really at opposite ends of the spectrum, and
Yeah.
both of them, to your point, have an enormous value that's being created for the social fabric of many of American cities. Modular is a factory risk profile in a lot of cases, and how you think about the funding of that is about putting together the right sponsorship to manage the operations, but really ensuring the cash flows going into the factory are managed appropriately for the collateral that is coming out. Many lenders also struggle around modular, and that, like, listen, the lien priority set is not standard. And if you have a deposit structure where you have debt dollars potentially going offsite into a factory, it really takes a different type of lender to think through how to underwrite those risks and put the right type of lien structures in place, monitoring programs. And to be frank, a lot of these factories aren't quite as well balanced as what you'd like them to be. So you have to really be able to go and look at the balance sheets of the factory, understand how they're managing their own risk. And I'd say increasingly we're seeing factories be much more willing to have flexible payment schedules that take a lot of that off of the real estate risk that is associated with the construction lender. Now, that being said, it can be wonderful, and it can also be a very high risk profile that's hard to contemplate. And I think, like many of the lenders, we will not do those. However, we are very willing to lean in and try to unpack what modular means. And we've seen some wonderful examples of modular where they have reduced the financing costs by virtue of being able to deliver faster, reduce a lot of the operational costs and trade risks that you have on site. But it's just a matter of getting the right teams together for it. So we've got a number of modular players on our team that were modular developers who brought a lot of that learning into our ecosystem that we can apply. And we've underwritten several $1 billion worth of modular deals thus far, that many of which we haven't done, I think, give us a good playbook of what to avoid.
So let's talk about, many of our listeners here, JP, are developers. What, like, one piece of advice could you give to developer, or two pieces, or three, whatever, that's thinking about doing something modular? Because there are some pretty big pros and cons to modular. And I think that as developers today are looking to be more efficient and potentially lower their costs, they may overlook some of the downsides. So give us a couple of the pitfalls that you've seen. I know you finance some modular and whatnot. So let's see, what are the learnings from those $3 billion underwritten versus the few deals you've done?
Sure. Yeah. Number one, really understanding the cash flows going into modular factory from the deal itself, right? So what we had historically seen through 2021 was an example where you had 70 to 80% of the costs going into the factory. The payments to the factory were made prior to the delivery of the full run of units, which just presents the enormous risk of, say, the factory burning down. And there's 100 different factory burning down scenarios that you can have, but most importantly, it's the not being able to deliver because something interrupted that production schedule, and then you're out the monies. So what we've seen here is a shift toward more back-end payment. And I think for many developers that are negotiating with factories, don't focus as much on the total cost and focus more on the payment schedule. There's a lot more savings on the payment schedule, and frankly, you're not carrying that as in debt either, which again reduce the frictional cost of the carrying. Number two is really understanding the balance sheet and especially receivables of that factory, and that you're signing up to be in line behind someone else, most likely. And as a developer, you are betting on their ability to successfully deliver everybody in front of you. And if they don't, you lose your deposit. You're gone. Your timeline's gone. You have to go back and get in another queue. And so really doing your due diligence on the factory themselves, their ability to handle the type of volume that's being thrown at them. I'd say last but not least, do not overlook the quality of the set and stitch provider that you're choosing. And there are wonderful set and stitch providers that are out there and beyond that, there are probably one or two that have the track record that everybody's going to lean into and say, this is great. There's a lot that are great that don't yet have the track record. And I think you just have to be thoughtful about which you're choosing. But like groups like ProStitch, I mean, they have a wonderful track record to go choose from, and there are others like them, but be cautious about trying somebody new out, depending on your lender and how early you are in your adoption to modular.
Okay, great. David, you want to follow up on that or?
No, I think let's talk about co-living. What are your thoughts on that one?
So co-living is a great example. I'd say in contrast to the modular, which is more operational risk, co-living, I'd say generally is a great outcome in terms of the provision of housing supply and very proximate areas to jobs, schools, et cetera. That being said, it can be a very difficult one to underwrite in terms of valuation, cash flows in such a way that you're thinking about leverage and being able to max it out, but you have some unknowns or at least hard to quantify expectations. So when you look at markets like Los Angeles that have a very vibrant co-living spectrum that's already there, there are data points that you can pull, but even in LA, it's not easy to understand and unpack from afar. And so as a developer that may be embarking on co-living, you really have to lean into the data. I really encourage get market studies done, bring in appraisers or experts that have done a lot, have sort of seen the inside of deals to help counsel how you think about your cash flows. I think there is a space where you can put a lot of, you can go to higher leverage points on that type of an execution. However, if you have to do it, it's going to typically come with a lender who really understands that. Otherwise, you get very defensive because it is hard to unpack. So, I think about those types of deals. I like what they present. I think there's been an evolution from co-living 1.0 to 2.0 in terms of product, which is great. Getting much more to individual bathrooms and common living areas that are more so than a pass-through galley kitchen. Those are great, and they can be a very suitable outcome for especially the groups like medical residents is one I've seen a number of times. It's like such a great buyer or renter profile. If you can do that and you really build around that lifestyle experience you're trying to create for them, you can have great outcomes, and we've seen some very successful projects. In contrast, I think going all the way down to what looks like a single SRO, single room occupancy type of style, that's one of the things I think gets very dangerous, and it's hard to accommodate for the types of rents new developments require. And so I think we've seen an evolution from the late 2010s to present that has helped to overcome that in the newer product, but you still see it at times. I think from a lending standpoint, it does feel risky right now. We need, I think, more of a bull market to be able to absorb a lot of that product.
Good. And another follow-up question. You talked about sizing bridge loans and and what's the metric. And often we see bridge loans on apartments being sized to the potential takeout loan. Loaded question here. Where do you see interest rates going? Are you underwriting to an agency takeout at a typical 125 DCR? Give us a little secret sauce on the takeout.
Sure. Well, you have to ask the question, and I know I have to answer it because we do operate every day. However, I think the right answer to the question of how we're sizing loans is to admit day one, we don't know what the cap rates are. So little is transacting. Anybody in the right mind.
Few data points.
Yeah, there are very few data points on that. You have very limited information about what's really going on with the forward curve. And yes, as far as I've seen, it's never right. So with that being said, we place an increased amount of emphasis on debt yields in every deal, right? I mean, that's just much more objective in terms of how we think about it. And we will scale those up and down. And say generally, we like to see a 9.0 debt yield or above. We have absolutely gone down to 8 in certain deals. It's much less typical these days to go down to 8. We like 8.5 sort of as a floor, but we've gone to 8. 9 and 10 more realistic in many of these deals, though.
I agree.
When it comes down to DSCR, we always try to be very clear. We want to see a refinanceability of the loan, even if it's a build to sell strategy. And so when we look at that refinancing, typically we're going to look at 1-2 on horizontal multifamily and single family for rent DSCR. We're right now looking at mid 5s fully amortizing rates over a 30-year period. There are circumstances we'll underwrite to a HUD takeout, but it's
No.
just a matter of like how much time and lease up and seasoning do we have in the loan term itself, which it might, you have so much extra carry on interest reserve for some of those that it may not actually be productive. So we try to kind of balance those items out. But on the standard multi 125 DSCR is what we're trying to underwrite against in that example. And we do kind of keep tabs on the 10-year Fannie programs as a place we typically take the point of that.
Good.
So let's talk a little bit about our clients are generally real estate sponsors. Everyone's looking for construction loans today. Based on what you're seeing out there, what kind of advice would you have for our clients on what to look for when prioritizing lender selection?
Sure. Good question. So I'd say a lot of my perspective on this topic comes from past life. So I spent 10 years at Pulte Group, and I grew up, I feel like, during the GFC. I started in 2005, and most of my experience during 10 years in home building was unpacking a broken set of projects, repositioning, M&A, hard times, not easy times. I saw a little bit of the easy times, which leads me to better understand the hard times and how to get out of them. And so as I think about this question of like, where are we in the market? I think first and foremost it's important to have a very pragmatic perspective of where we are and where we aren't. And I think that as a production home builder mindset, our perspective is we don't get to stop building through the GFC. We have to keep buying land. We have to keep building. We have a workforce to employ. There's just not going to be home runs. We hope we hit a bunch of singles and maybe get a double along the way, but we're not going for grand slams. And I think as a sponsor in this market, it's very important to be pragmatic about what the market has to offer and set up a capital stack and a set of assumptions in your development strategy that align with what might happen. And what might happen, at least as a lender, is never the good stuff; it's the bad stuff. So when I think about it, it's about making sure that you're picking patient capital partners. Those that understand where the market is and aren't betting on home runs. And the worst thing you can see is like a sponsor betting on a single and a capital partner betting on a home run, and now you have a real mismatch. And so when I think about it as a construction lender, the last couple of years have taught us, if they've taught us one thing, is that there are going to be rainy days. And we don't necessarily know how that'll manifest going into any one project, but there are going to be challenges. Not going the way Excel is going to show it going into the project, but we're going to have weather delays. We're going to have supply chain issues. We're going to have cap rate movement. We're going to have stuff that's unplanned. As a construction lender and as a sponsor, you are partners regardless of how you want to look at it. And I think that many lenders in asset management tend to have a really kind of, I'm on the other side of the table, fix the problem and call me when it's done, or cut the check to pay me down or pay me off. As a lender, at least from our standpoint, we want to be the first call when something's going wrong. We want to help you solve it. We've seen more deals most likely than the sponsors have done. And we have other contacts they may not have in their back pocket. So said differently, I think we can usually help, and we want to. So we've set up our asset management teams to do that. And I think as you're looking at lenders, play out those scenarios. Do you have the team to help? And talk to some of the borrowers that have gone through those types of situations with that lender. I mean, obviously a lender is going to have references that are usually good scenarios, but find somebody who's gone through a difficult situation with that lender and make sure you understand how they act. The second piece of that is understanding where their capital comes from. Discretionary funds from a lender are flexible funds. They are ones where you can sort of make decisions about how you deploy them, how you manage them within the managing partnership. As you think about this, when you're going into securitizations or banking, they have a lot of more regulatory problems that they can't necessarily express their own discretion about. And so when we look at bridge loans, quarter point, 50 basis points rarely is going to ever have enough of a financial impact. A hiccup in the middle of a loan where there's a stop funding event can be very binary. So our 2 cents, and obviously this is very biased, but I think objectively, the right thing to do is to find the partner. And there's a lot of great banking partners, a lot of great securitized lenders that are out there, but make sure you understand how to navigate that hard time with the group that you're choosing.
Yeah, I have a question on markets. So as we've seen, no surprise in the recent years, the smile states, the usual suspects, overbuilding has occurred. Phoenix, Boise, certain markets like that. I've also been hearing that there's some of the ignored markets, like New England markets, or are now emerging as, you know, as supply constrained and new opportunities. Tell me, like, without, you know, that's not Texas, Florida, Arizona. Give Talk to me about a market that you think out there is kind of underappreciated right now
Um,
as we come into the post heavy construction cycle.
yeah, it's a great question. I think that probably all of us in the market in some way talk about, ask about, think about every day. One that comes to mind for me is Knoxville, Tennessee. And I think that a lot of these Midwestern markets are ones that are haven't gotten an enormous amount of attention. There may have been institutional capital that's come into them, but like a Columbus, Ohio, but still they're underbuilt and they're not getting nearly the enthusiasm thrown at them as these Smile State. And I think if you look at just in Tennessee, obviously Nashville is exactly that story. Massive amount of multifamily urban supply that's come in. But go to Knoxville, Knoxville has got about a third of the vacancy rate and seen very little active development, and that has had rapid increase and rapid lease up and rapid increase in actual in rates in rents themselves. And so I really like that secondary market strategy. But what's interesting when you think about a market like Knoxville is it has two very large anchor employers. You got University of Tennessee, Tennessee Valley Authority, two massive employers that are sitting right there. They are not going anywhere. They'll be there for another 100 years. And so when you think about these types of employment bases, I'm not going into a secondary market without a really strong demand driver. I'm actually going in with a really strong amount of demand that's undersupplied. And so we've had a number of, I'd say, college town investments. We've got one in Ann Arbor, Michigan that we love. And there is no competition in those markets and that's a for sale community. There's no competition in those markets. So we're seeing really outpaced selling environment, selling above the asking prices, which gives us a lot of comfort going into those. And the thing you have to get comfortable with up front is you have to unpack the market. So it can be difficult to get there. And I think it's hard if you're a lender who just likes to go out and put money out and issue term sheet, be quick. It's hard to understand some of these markets, get other people comfortable. But if you really do unpack them, they can be great. So when I talk to sponsors, I really encourage sponsors to think about some of these other markets that have strong job bases that aren't feeding off a drive till you qualify type of mentality. Rather, I can nearly walk to the jobs or the housing demand driver.
Mm-hmm.
It's got a really balanced outcome of supply.
Got it.
Good.
Do you have any questions or topics that we're missing here, JP, as we kind of start to wrap the interview up here? I want to make sure we're covering the gambit here.
Well, I think in the spirit of like how sponsors should think about navigating this market, and I think this is it's different by geography. What I've seen that's maybe interesting from a lender's perspective, we've seen an enormous amount of shift from sponsors who are being focused on vertical build to rent execution to go into land sales or go into for sale execution and being, I think, very nimble and thoughtful about the strategy of what's going to succeed over the next year versus what working last year. And that the generic statement of always be thinking about tomorrow, I mean, it's obvious in every market. However, I think that as a developer, you get entitlements set in stone, you get a lot of things that seem very rigid, and it can be hard to rethink. And I think what we're seeing a lot of developers who have been constantly reinventing themselves through the last decade, the winners are always thinking about that. And I feel like some of the best sponsors we've seen, they've been prudent to be quick to make those pivots as it's necessary, as opposed to trying to like continue to push through something that the market really is accepting right now.
So it's changing their opportunity set.
Mm-hmm.
Yeah. Well put. And that's manifested on example built to rent communities as being I'm going to go sell these as say improved lots to public builders. It could be I'm going to take it for sale, but there are a lot of profits, and we look at it through the lens of my time series for profits. You can have big wins in those, and frankly, it can create other downstream opportunities. But we look at this window of time in the market as one where I think as a group, as an industry, we're going to look back at there was a lot of opportunity that you either decided you're going to lean into and run against the kind of curve of the market, or you're going to look back and say, I wish I had. And so I think that this market is not one to be just like blindly going into, and not everything's going to work, but there are an enormous amount of opportunities that aren't being capitalized, that aren't being pursued right now. And we are sitting in a housing deficit in such a way that people will capitalize on them.
So let me push back on that a little bit, because I think I do agree with you, but I mean, it could be said from our listeners, easier to say that when you're a lender and your basis is, 30% lower than mine. So that I think goes to your last point on optionality and being careful when putting deals together, that you're doing so in such a way that you have some optionality, right? So I think that's part of what our job is here at GSP as well. But yeah, I think you're absolutely right, JP. I think there's a lot of opportunity out there. David, I don't know if you disagree or.
No, I do agree, and I mean, there's also the optionality of even we're seeing some people think, is it even time to do anything right now? I've been getting that question a lot, or should I just sit on land? I in fact had a long conversation with someone about that yesterday. So yeah, the optionality is critical.
Yeah.
I think about changing your opportunity set. So it's a good way to characterize it. And it's not about I think about a multifamily developer in LA versus a developer in the Southeast. Those opportunity sets are different. But if I'm sitting on a multifamily opportunity in LA, I may want to be a little bit cautious in the speed at which I'm going after it in favor of putting some of that additional capital toward something else that has a bit more optionality. So, it's just about being very cognizant of where we are in the cycle. And what those opportunities for the next 6, 12, 18 months look like, investing against them. But there's a lot of great perspectives that are there. And I think that if I did summarize it all, I was sitting with a sponsor having this conversation. And it was like, get a lot of perspective. Don't let yourself be insulated from the various experts in the market and, lenders, equity providers, advisors, everybody's got some lens into things are and aren't working. And I think you have to process all of those as opposed to sort of having my own one myopic version.
Interesting. Good. Great. Well, we try to keep this short, sweet, and to the point. JP, we really are honored to have you here today. And thank you for joining us.
Thank you very much.
So JP, just one more time, where can people find you online? Learn more about your company? Give us that here right at the end as we wrap up.
Appreciate it, guys. It's been a pleasure to be here. Check out techorec.com, techorec.com. And feel free to reach out. We look forward to opportunities to continue to partner with you guys, and appreciate the time to be here.
Yeah, we're glad to have you. Thank you all.
Thanks, everyone.
We'll see you next time.
Thanks, everybody.
Right. Bye-bye.